Have you ever noticed something strange about buying a car? Most people don't really ask, "Can I afford this car?" They ask, "Can I afford the monthly payment?" And that small shift in thinking changes everything, because once a car becomes a monthly number instead of a total price, it stops feeling like a big financial decision. It starts feeling normal, manageable, almost harmless. But that feeling is exactly what makes it so powerful. Let's look at a very ordinary situation in the US or Europe. A young professional, maybe in their mid-20s or early 30s, earning around $3,500 to $5,000 a month after tax. Not rich, not struggling, just stable. Their monthly reality looks something like this: rent or shared housing, $1,200 to $2,000. Student loan repayment, $200 to $500. Credit cards and subscriptions, $100 to $300. Food, transport, daily life, $600 to $900. Already, a large part of the income is spoken for before any real life enjoyment even begins. And then comes the car decision. A dealership offers a car for $28,000 or $35,000. But that's not how it's presented. It's just $399 a month. Only $450 a month. Affordable financing available. And suddenly, the conversation is no longer about spending tens of thousands of dollars. It becomes, can I handle another $400 monthly payment? And, compared to rent, insurance, and everything else, the answer often feels like yes. So the decision gets made, not because the car is necessary, but because the monthly structure makes it feel safe. Now here's where the quiet financial mistake starts to build. Let's say the payment is $450 a month for 6 years. That's $5,400 per year. Over 6 years, that's $32,400. But the car itself might have been worth far less by the end, especially after depreciation, interest, and fees. So what looked like a manageable monthly expense quietly turns into a large long-term commitment tied to an asset that loses value every single year. And the important part is not the math itself. It's how invisible that math feels at the moment of decision. So why does this happen so often, even with educated, responsible people? It's not ignorance, it's psychology. Because a monthly payment feels like control. A full purchase feels like loss. Paying $30,000 up front, or even thinking about it mentally, feels heavy, even unrealistic. But $399 per month feels like a subscription, like Netflix, like something you can cancel later, even if you rarely do. There's also another layer: identity. A newer car quietly signals stability, success, and progress, even if financially it delays real wealth building. So the decision is rarely purely logical. It's emotional, social, and psychological at the same time. Now imagine this same person 5 years later. Their income may have increased slightly, or stayed almost the same after inflation. But one thing is consistent: fixed monthly obligations didn't disappear. In fact, they multiplied. Another car, a slightly bigger apartment, a few upgraded lifestyle choices that all started as just monthly payments. And what's left is something many people don't notice until much later: a stable income that never feels like freedom, because a large portion of it is already assigned before it arrives. Now compare this with a different way of thinking. Not extreme, not unrealistic, just slower. Instead of asking, "What can I afford monthly?" the question becomes, "How much of my future income do I want to pre-commit right now?" People who build long-term financial stability tend to treat debt as something that reduces optionality, not because debt is always bad, but because it quietly removes flexibility. Every fixed payment is a small piece of future freedom already spoken for. This is why the car loan decision is not really about cars. It's about how easily long-term commitments can feel short-term, and how quickly manageable becomes normal, even when it compounds quietly in the background. The interesting part is that financially stable people are not necessarily avoiding cars. They just delay the structure. They either buy cheaper, drive longer, or prioritize ownership only when it doesn't compete with savings, investing, or liquidity, not because they reject comfort, but because they understand trade-offs don't disappear just because they are monthly. So the real shift is simple, but not easy. From optimizing monthly comfort to respecting long-term financial space. Because financial freedom rarely disappears in one decision. It usually fades through a series of decisions that all felt reasonable at the time. And maybe that's the most important part of this entire topic. Not that car loans are good or bad, but that they are designed to feel smaller than they actually are in the context of your future. If this helped you see the pattern a bit more clearly, consider subscribing for more calm, real-world breakdowns like this.